Well, we are having this very special interaction with Sanjeev Gupta of the Liberty House Group, all the way from UK. Mr. Gupta, thank you so much for chatting with us. Great to have you on the channel. Now, Liberty House is such a nicely diversified industrial house in commodities, capital goods, power, automotive components spread across countries, running into billions of dollars and pounds. How is it to be right now facing this, epidemic-led slowdown, one of its kind, seen in over a century? How are you really dealing across your businesses with the slowdown which has gripped the world?
No, undoubtedly, this is a once-in-a-lifetime challenge. None of us have ever experienced anything like this before. So we are reacting. We are basically known for our agility. So we've reacted very quickly, shifting production patterns, making them match to different markets, different requirements, and so on. Going on our efficiency drives and so on and so forth. But while these problems are all required to be tackled carefully and quickly, this also, we believe, is an opportunity to accelerate changes which were already in our motion. So you would have seen, or you would have heard about various projects which have been accelerated. Our project in Australia to go to green steel, putting a new DRI plant based on hydrogen and natural gas. Our project in Romania, similarly, putting a new DRI plant based on natural gas and hydrogen. Our investments in the UK, our investments in the Czech. So all our investment strategy basically is being accelerated. We see that this crisis will bring about a greater need for local investment and regrowth of economies.
So are you telling me that you have not really reworked your numbers, lower your capex, which you have planned up in a new COVID impacted world? Apart from, of course, going through better efficiencies, aiming at cutting costs, which most of the business houses are doing, have you also taken into trimming of expenses and many others? Which are the areas? What kind of savings are you doing by those kind of activities?
No, so we announced our global 30% efficiency drive. This 30% efficiency drive means different things for different plants and different countries and different locations. In some places, it does mean cutting costs. It does mean, unfortunately, some headcount rationalization as well. In other places, it's just changing our operations, because since production is down everywhere, our production in general is down 20-30% across the globe. So we have to readjust our operations, look at our shift patterns, how we operate, where we operate, what raw material mixes we use. So basically, the idea is that we want, within a short period, to achieve a 30% efficiency improvement in every operations across the globe. So that is definitely a direct result of this pandemic, and we're taking on that challenge head on. What I was saying was that while we take on those challenges and while we adjust to the market conditions, which will, in our opinion, last for another year to 2 years, at the same time, we're also accelerating our investment strategy towards making our plants more efficient, more green, and driving towards our carbon neutral target of 2030.
I understand. You've been running these businesses through the cycles in various geographies. And of course, we are seeing that various geographies and countries are gradually reopening their economies in the last couple of weeks. What are the early indications are you getting? What are you reading in terms of demand? How long do you think, or how deeply impacted would various geographies you're operating in would be impacted by slowdown? Some people are talking about a V-shaped recovery. Others are saying it could be much more prolonged. What are your thoughts since you've got skin in the game in various geographies as well as businesses?
Yeah, so a general point I'll make is we definitely are not subscribers to the V-shaped recovery. This crisis will last longer than any other crisis in history so far. But it does depend on geographies. In some places, recovery will be faster. For example, in Australia, we expect a faster recovery. In Europe, we expect a much slower recovery. Sector-wise as well, we think construction will be less hit, but automotive and consumer goods will be much worse hit. Anything which is related to consumer confidence will take time. Will take, in our opinion, between a year and a half, maybe up to 2 years for a full recovery.
Right. Let's shift your focus and our viewers' focus to India, where you have been eyeing opportunities for over 2 years now, and you have, you have actually circled upon assets and have even picked some from the stressed asset side. Now we are getting indications that the group is keen on further opportunities and is looking at assets. Talk to us about your India strategy. What are your plans over here? And now with this slowdown which has hit Indian economy as well, are you seeing better valuations of the sectors and businesses you are interested in. What exactly do you have on your drawing board?
So naturally, given our the Indian origins of the group, there has been a calling to make India a real center for our business for a long time, and we've been examining that for a very long time as well. We tried to come into India last year with great ambition, as some of those journeys were a bit more fraught than we had imagined, but we finally landed on one good asset, which we're now focused on reopening and developing and growing, and that will set the foundation, let's say, and we will definitely grow our business in India. We expect India to be amongst our major hubs, same as UK, Europe, US, and Australia, and we will look at all opportunities in our sector. So our sectors basically are steel, aluminium, and renewable energy. In all these three sectors, we'll look for opportunities and we'll look to make India a substantial part of our group.
How's the environment looking right now to be having sizable exposure in the commodities business, metals particularly, even in the Indian context, given that the sheer demand for the commodity would be much lower next 14, 18 months? What is your own assessment of the cycle in the commodities space?
So first of all, remember that steel is not used to having ups and downs. Steel is a very cyclical business. So this is no, in terms of us facing a downturn, is not something which is particularly special. It is true that this down cycle is worse than it has been in previous cycles, but nonetheless, steel companies in general, or industrial companies in general, are well equipped to handle ups and downs in cycles. But fundamentally, the demand for steel is growing. In the next 30 years, the demand for steel will double globally. Fundamentally, the demand for aluminium is growing. Fundamentally, the demand for energy is growing. So we are in sectors which are growth sectors overall, but we have to go through short-term ups and downs. The other point is our model is very much based on making sure that we, A, utilize local resources, and B, that we invest for the future. So we believe very strongly that the future of our industry is going towards green steel and green aluminium. Hence, we have invested very heavily in renewable energy. We are investing in converting all our steel plants to green steel. Aluminium, already our two smelters are basically the greenest in the world. So as long as we are progressively adopting new technology, new investments, and looking to the future and focusing on local resources and local markets, that business model will always be robust no matter what the economic conditions. And sometimes crises like these actually bring about the ability to accelerate some of our strategies and growth. All governments globally are very keen now to see local investment, local supply chains. The frailty of the globalization model has been shown to everybody. Hence, there will be an accelerated or an enhanced focus on local industrial investment. You saw our announcements in Romania, where together with the Romanian Prime Minister and all their ministers, we announced a very ambitious 4 million ton green steel plant. There was a partnership announced with the government, with Romgas, which is a national gas company, with the Exim Bank of the country, with all the key stakeholders to accelerate this change towards green steel, which Europe is leading, but other countries in other parts of the world are also following now. So we see an enhanced environment for investment and for accelerated growth towards environmentally friendly industries across our different sectors.
Very interesting, Mr. Gupta. You brought up that point. Deglobalization clearly is gathering pace, and back home in India, our government and leadership have also announced Atmanirbhar, ambitions of being self-sufficient or self-reliant in most areas of strategic importance. How are you analyzing the Atmanirbhar, scheme, or I would say the process which the country has moved towards, and how do you see large business houses setting up greenfield projects here, or starting from the base or around that, the way you are doing right now? What are your thoughts on Atmanirbhar plans of our country?
So I think in every country there is opportunities for us to basically reshore or bring home industry which is currently based on imports. UK is also a very good example. Half our steel which we consume in the UK is currently imported. So there is a clear opportunity. India also, as it grows and it needs more and more resources like steel, like aluminium, like energy, will need more and more production if it is not to start becoming dependent on imports. So all these countries, what we need to analyze is what is their local resource. In the UK, for example, we don't have any iron ore, we don't have any coal, we don't have gas. So we don't have the basic raw materials which you need to make steel. So industry, we would argue, why would it be able to prosper here when you have no raw materials? But what we have is a good market. We have a 12 million ton steel market. Over 7 million tons today is imported. And what we have is an abundance of availability of steel scrap. UK exports 7-8 million tons of steel scrap. Availability of scrap in this country will double. It will go to over 15 million tons in the next 10 years and towards 20 million tons in the next 10, 15 years. So we should focus on that raw material rather than focusing on imported iron ore and coal, which the country mainly does at the moment. So, and if we apply ourselves to that methodology, if we basically focus on what is available locally in terms of natural resources and how do we adapt those natural resources to apply to industry, that is the most successful model and most sustainable model.
So in India also you have more towards moving towards green steel, which is recycled steel, because as it is our country is producing quite a lot and consuming quite a lot, so scrap steel volumes will be higher. Is that the plan? Can you share with us 4 or 5 year roadmap now that you've taken over an asset?
No, you see, this green steel has two ends to it, two bookends. Let's say one bookend is recycling scrap, and the other big bookend is producing new virgin steel but using hydrogen rather than using coal. So, which is the two strategies which GFG or Liberty has basically adopted. The recycling of scrap actually is more applicable in developed countries because there is accumulation of steel through the last history. So in the UK, since the industrial revolution, there has been an accumulation of steel in the economy. The UK economy has almost 1 billion tons of steel in its system, all of which has to be eventually recycled. So the availability of scrap is higher in countries which have developed earlier. So in India, the availability of scrap is limited. So the opportunities for recycling are there for sure. And we are basically already in Adhunik, we will be recycling some steel scrap, but the opportunities are limited. So India has to go towards hydrogen steel. And that comes from availability of cheap, natural, renewable energy. As long as renewable energy prices keep coming down in India, which they are certainly already doing, the opportunity India will have is to develop hydrogen and hence to develop hydrogen steel. So we will definitely go on this journey in India as well. We are already on this journey in other countries, like in Australia, like in Romania, where there is availability of iron ore and also availability of natural gas, and eventually availability of hydrogen as renewable energy becomes cheaper and cheaper. So that's the green steel journey which Liberty is on. On the one side, it's recycling in countries like the UK, where there is an abundance of scrap. And on the other side, it's making hydrogen steel in countries like Australia and Romania, and hopefully eventually in India.
So next 4 or 5 years, do you see the group having its presence in steel alone, or do you think auto components would also be following, energy or power generation would also follow? Where do you see the footprint 4 or 5 years far out here in India for you?
So the three main industrial verticals for GFG are Liberty, Alvance, and Cymec. So Liberty focuses on steel, but also on its downstream applications, including auto. Similarly, Alvance focuses on aluminium, but also on downstream components, including in the automobile sector. And of course, renewable energy feeds both the steel and aluminium business. So these are the three industrial verticals. We will pursue growth in all of these three, which will also include some downstream businesses for those businesses.
Talk to us about you're operating in such large format in terms of countries, scale of operations, etc. There is this wave of geopolitical nervousness which is sweeping the world right now, and China is in the center of it, where you do a huge amount of sourcing for your various businesses as well for commodities, be it US China or recently even Indo-China. For a group which operates at that scale, how is geopolitical issues as a risk? Do you see that? And from the capitalist point of view, does it to a certain extent also put a roadblock in free flow of capital across the world? What are your thoughts on this issue?
So there's swings and roundabouts. There is definitely having geopolitical tensions is not good for global growth, and it is an impediment. It is unfortunate, and one would wish that there was more harmony across different power groups in the world. But it also brings a clear opportunity. GFG has always been about localization, about local economies, and not globalization. We have always advocated that the era of globalization is over, and all countries need to focus on their domestic economies, on their domestic manufacturing. Again, as we talk about the UK, for example, the domestic share of industry in the UK has dropped from 30% of GDP to under 10% of GDP. This is clearly unsustainable because it causes lots of unemployment, or let's say imbalances in employment between cities and industrial areas, and which is what led to Brexit and other issues. And similar issues have happened in many other countries as well. So the reindustrialization of certain countries is very important, and we have always been an advocate and a player in that field, which will now get accelerated or heightened by this current crisis. Both the COVID crisis showed that local supply chains are very important, and also the geopolitical tensions which have been heightened by this will also again make people focus on their own industries rather than looking at globalization and having global supply chains. Supply chains will definitely become more local, which clearly presents an opportunity for industry to invest and to basically to build ecosystems within their own domestic economies.
Mr. Gupta, leave us with your thoughts and plans and strategy of the group in other geographies. Australia, you're looking at several assets in advanced stages, and in order to grow them, progressing on them. Tell us the way forward for the group in other geographies, key geographies, and what are the plans there?
So again, as I was saying earlier, our focus in every geography is based on local resources and the local market. In the UK, we are not focused on import and producing steel because this is not viable, which is why our peers in the, whether you look at the steel industry in the UK, it's been suffering for a very, very long time because of that. On the contrary, if you look at our furnaces in Rotherham, which we bought from Tata, we've doubled production already, and we will double production yet again. How and why? Because we have local availability of scrap, and the only missing ingredient is energy. Energy is expensive in the UK, and we're trying to solve that ourselves by investing in our own energy plants. We are doing the world's first conversion of a coal plant to use end-of-life waste, which will give us a real competitive advantage and will really support our new project in Newport, where we're going to build a 2 million ton electric arc furnace scrap-based steel plants, which will be powered by our own energy. So the ingredients are there. We just have to work on them. The market is there. UK imports more than half the steel it consumes. We have availability of raw material, steel scrap. Energy is a missing ingredient because it's too expensive, but we're investing in energy ourselves, which gives us a unique competitive advantage against our competitors. Similarly, now, if you go to other countries, if you go to Australia, for example, Australia has some of the best renewable energy. We have our own project in Australia, again, Australia's largest solar farm, which is being built. With the reduction and lowering of renewable energy prices, the viability of aluminium will increase, viability of hydrogen will increase. And as hydrogen becomes cheaper and cheaper, we'll be able to use hydrogen as a substitute for carbon in making steel. Hence, we have launched our DRI plant-based project there, which will basically substitute our blast furnace, which will initially be based on natural gas, but eventually will replace hydrogen as its feed. A similar project was launched in Romania, as I was mentioning earlier. And again, other countries such as, if you talk about the US or Czech, where there is availability of scrap, we'll be focusing on that. So we're focusing in the steel sector, at least either on scrap or on hydrogen steel. In aluminium, we're focusing on green energy, again, powering aluminium. And our renewable energy business will feed all these businesses. So in every geography, our strategy is more or less the same. It depends on what local resources are available and how you can best deploy them, and what is the local demand and what is the gap in the market, what imports are basically currently coming in, and what can we do to substitute those imports with local production on a more competitive and a more sustainable basis.